Welcome back to Debit Credit Done, the podcast that makes accounting simple, practical, and totally passable. I'm your host, Dean Quartermaine, and this is episode 3 of our second series covering the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. So far, we've explored accounting principles and built a trial balance. Today, we're going to tackle non-current assets and how we record them, how we dispose of them, and how we account for part exchanges. We'll also walk through some detailed disposal account entries, something that is vital for your AAT exams and for practical accounting roles. So firstly, what are non-current assets? So a non-current asset is something a business owns and intends to use long term, typically for more than 12 months, and is not something that they purchase for resale. So some examples: motor vehicles, machinery, equipment, and then land and buildings. So, premises, offices, warehouses. We don't typically buy those with short-term intentions, do we? We buy them with more long-term intention. Now, it's worth saying that some books will refer to these things as with slightly different terminology. So certainly as you progress through your accounting journey, you'll hear these things mentioned as tangible non-current assets or tangible fixed assets. Now, they're tangible in the sense that all tangible means is that you can see it, touch it, it's got physical substance. So you can see, feel, touch a motor vehicle, can't you? But the flip side of that, something that's an intangible asset. So think about patents, software licenses. You can't really see them, so they're considered to be intangible. Another way that the non-current assets are sometimes referred to, and certainly at level 4 and on the chartered accountancy exams, is as property, plant and equipment, so PPE, but not to be confused with personal protective equipment. Yeah, PPE, property, plant and equipment. Yeah, that's how non-current assets are typically referred to, certainly at level 4 and in terms of international financial reporting standards. So the key thing with non-current assets, as we hopefully know, and if not, you will do in a few seconds' time, is that the cost of these non-current assets is spread over time through this concept known as depreciation. We'll talk about depreciation more in episode 4, but it's just worth saying that non-current assets don't affect profit directly. They do indirectly through depreciation. But if you buy a new van today, you don't put the whole cost to the profit and loss at that point. The cost is spread over some sort of agreed lifetime through this concept known as depreciation. Now, the second concept that is important to understand and be able to differentiate between is that of capital and revenue expenditure. So capital expenditure is expenditure that businesses have related to the creation and improvement of assets. Yeah, so if you think about a non-current asset, when we buy that non-current asset, so buy a motor vehicle, we're incurring capital expenditure in order to do that. Improvements of assets, so if I, for example, bought a warehouse and then decided to extend that warehouse, well, that's improving the value of the asset, so arguably that'd be capital expenditure. Revenue expenditure, that's your day-to-day expenditure, so that's just your day-to-day running costs for your business. Now, revenue expenditure is charged to profit and loss as the expenditure is incurred. Capital expenditure is added to statement of financial position and not charged directly to statement of profit and loss at that point. So some examples of what would be capital expenditure and what would be revenue expenditure. Capital expenditure the buying of a new van. So if you buy a new van, it's very much capital expenditure. You're buying an asset, you're creating an asset in that company. If we then went and serviced that van, so we needed an MOT, let's say, yeah, well, that's not improving the asset, is it? It's not creating a new asset. What that is just day-to-day running cost. So the servicing of the van would be revenue expenditure. Now, it's important that we understand that to know where the cost sits on what financial statement the cost will sit. And also, it's almost bound to be a question on your AAT exam. Here's some different types of expenditure, some different entries. Please tell us whether or not they are revenue expenditure or capital expenditure. So if you understand the difference, you can answer the question. So now moving on then, what we want to look at is this whole concept of non-current assets. So if we think about a life cycle of a non-current asset, the very first thing we're going to do is we're going to purchase a non-current asset. Another word for purchase is acquire. So we're going to acquire a non-current asset. So let's just walk through a bit of an example of what happens then when a business buys a new asset. So we've got a frictional business, completely made up, yeah, and we're going to buy a piece of equipment for £15,000, and we're going to pay for that with funds we've got sat in our business bank account. So if we think about what the journal entry would look like for that transaction, we debit equipment for £15,000. So that's the asset we've just bought. Remember your dead click. Yep, increasing the value of an asset. If you increase the value of an asset, you debit the asset. So we're going to debit equipment £15,000, and then we're going to credit our bank asset for £15,000. Now, it's a credit because we're reducing the value of the asset. Remember, you increase the value of the asset, it's a debit. If you decrease it, it's a credit. Now, if we purchased it on credit, so something slightly different, we purchased the same asset but did it on credit. So we still bought the asset, so we still need to debit equipment for £15,000, which creates the asset within our accounts. But we didn't pay for it straight away, we paid for it on credit. So we're going to debit equipment, £15,000, and we're going to credit payables, yeah, for £15,000, which is an increase to a liability. Yeah, if we increase liabilities, we credit them. Now remember that assets are recorded at cost, which includes any installation or delivery charges, and anything else that brings that asset into use within your business. We'll talk a little bit more about that in future episodes. So now you've got the asset, yeah. So over its lifetime, you're going to depreciate that asset. Now, I've almost left depreciation for today. We're going to talk about that in episode 4. But ultimately, the asset gets depreciated over time, over its life. And then at some point, you get rid of the asset. So another word for getting rid of it, as well as selling it, is disposing of the asset. So what does that really mean? Well, we could sell it, yeah, we could gift it, so we could just give it away, or we could lose it, yeah. So think about laptop computers, people leaving them on trains, yeah, it happens all the time. Or it could be stolen or lost as a result of some other external event, such as a fire, flood. However, if we no longer as a business have control of the asset, we've disposed of it. Yeah, and when we dispose of an asset, we don't just delete it out of our accounts because it did exist. Yeah, remember, we never delete accounting transactions. Yeah, we just reverse them if we need to. Yeah, we never delete them because we lose our audit trail if we do that. So there's a 4-step process then that we're going to go through in terms of the disposal of non-current assets. So the first thing we need to do is remove the original cost of the asset. So every asset costs something to your business originally. We're just going to remove that cost. We're then going to remove any accumulated depreciation. So all accumulated depreciation is depreciation each year, put it all together, and over the lifetime of that asset, what's its total depreciation? We're going to get rid of that as well. So we're going to remove that out of our accounts. And then we're going to record the proceeds that we received on the disposal of the asset, if indeed we received any disposal proceeds. Once we've done that, we'll be able to calculate whether or not we've made any profit or any loss on disposal. Now, remember, that's not physical, actual profit or loss, is it? In such that, you know, you bought an asset for £5,000 and you've sold it for £2,000. Well, clearly you've not made money. Yeah, bought it for £5,000, sold it for £2,000. But it's all about what the book value of the asset is against the money you received, and on paper, what's the paper profit you've made or loss. Yeah. Now, all of those 4 entries I've mentioned, so the removal of the original assets cost, the removal of the accumulated depreciation, the recording of the proceeds, and the calculation of profit or loss on disposal, one side of all of that is going through what's known as a disposals account. So the disposals account is the key to all of this, because that's what allows me to calculate this profit or loss on disposal. Yeah, it's the other side to all these entries we're making. So when we remove the original assets cost, the other side of the entry is going to the disposals account. So I'm going to walk you through an example. I'm going to put the example up on the screen as well, for those that are watching the video. I'll talk you through it as well. So what we've got then, first thing we've got is a scenario. So the scenario is that we're a business and we originally bought a piece of equipment for £10,000. We're now going to dispose of that piece of equipment, and at the point of disposal, we've got accumulated depreciation of £7,000. And we're going to sell this asset for £3,500 and receive those funds, those disposal proceeds, into our bank account via bank transfer. So we're just going to go step by step through the process of what we need to do to account for the disposal. So first thing we're going to do is we're going to transfer the assets cost to the disposals account. Yeah. So we're going to debit disposals. Yeah. And then credit the asset account. Yeah. So we're going to debit disposals for £10,000. That's the initial cost of the asset. And we're going to credit the equipment asset for £10,000. That's the effect of removing that piece of equipment from the equipment asset account. Yeah, because when we originally recorded it, we would have debited the account. We're now crediting the account for the same amount, removing the impact of that transaction. We're then going to do a similar thing, but transfer the depreciation to the disposals account. So we're going to debit accumulated depreciation for £7,000 and credit disposals for £7,000. Yeah. So that gets rid of the accumulated depreciation out of the accumulated depreciation account. Yeah, which would be sitting in there as a credit. So we've now posted a debit to offset that and credited disposals. The third thing we need to do then is record the disposal proceeds. So I mentioned the disposal proceeds were paid into our business bank account. So we're going to debit our bank asset, £3,500, and credit the disposals account for £3,500. So at this point, we've transferred the cost of the asset to disposals. We've removed the accumulated depreciation, and we've recorded the sales proceeds. What we now can do is balance the disposals account to identify whether or not we made a profit or a loss on disposal. So, in our example, in the disposals account, we've got one debit entry of £10,000, which is the initial cost of the asset. And then we've got 2 credit entries. We've got the accumulated depreciation, the opposite side of that, sitting in disposals, £7,000. and then the opposite side of my sales proceeds. So £3,500. So I've got £10,000 debits, £10,500 of credits. To balance that, then we need to stick £500 onto the debit side to balance it. So what we've got there is a profit on disposal. The credit side's higher than the debit side. We've got a profit on disposal. Yeah. If it was the opposite way round and debits were higher than credits, we'd have a loss on disposal. And then the final thing we need to do is record that profit. So we're going to debit disposals, how we balance it up essentially. Debit disposals for £500 and credit profit on disposal on the statement of profit or loss for £500. That balance the account, that balance the disposals account to zero, and we'll have moved the profit or the loss, profit in this case, onto the statement of profit or loss. If it had been a loss, obviously the entries would be reversed. Now that's all great. That's just a standard disposal where an asset's sold for cash. However, in the real world, what happens, although we do that, there are many examples of people doing that. There's also many examples of people not selling their assets for cash. Yeah, so you don't sell the asset to someone for cash. What they do is they trade it for a new one. So that's where part exchange comes in. Yeah, and it's a scenario that comes up quite regularly, both in AAT exams and, as I mentioned, in the real life business transactions. So if we think of it like trading in your old car when you buy a new one, you're not just disposing of your old vehicle, but you're also acquiring a new one. And the value of the trading becomes part payment of this new asset. Now, all that sounds a little complicated, but actually it's really simple. Yeah. So what we're going to do is we're going to do something very similar to that simple disposal, the standard disposal example, but we're going to look at a full part exchange example. Yeah, which again uses the disposals account and shows how to record the full cost of the new asset. So again, I've got this up on the screen. This is a scenario for the part exchange. And then we'll walk through what we need to do. So the scenario is the old van cost £12,000. And at the point of disposal, it's got accumulated depreciation of £9,000. And what we're doing is we're going to part exchange our old van for a brand new one. And the brand new one cost £18,000. And the dealer we're buying the new van from says, we'll give you £3,500 allowance for your old van, and we'd like you to pay us the difference from your bank account. So, the first 3 steps of this, or certainly first 2 steps of this, are exactly the same. The third step is very similar, but we're going to walk through it as we go. Yeah, so the first step we're going to do is transfer the cost of the old van, out of the asset account into disposals. So we're going to debit disposals for £12,000. That was the cost of the old van. And then we're going to credit the van account. Yeah, I've made it quite straightforward on the screen. Just put old next to van so we can see that clearly it's the old van, but we wouldn't have a separate asset account for the old van and the new van. It'd all just be probably motor vehicles at cost. But I'm trying to just break it down, make it very simple for you. Yeah, so we're going to debit disposals £12,000, credit the van account, motor vehicles, £12,000. That gets rid of the initial cost of the old van. We're then going to transfer the accumulated depreciation. So we debit accumulated depreciation for £9,000 and credit disposals for £9,000. That's now got rid of the accumulated depreciation from the accumulated depreciation account and put it into disposals. Now this is where it comes a little bit different. Yeah, so step 3, we don't actually have any actual physical cash proceeds, do we? all we've been given is a part exchange allowance. So we need to record that trading proceeds part exchange allowance. So we're going to debit the new van. Yeah, so it's still the motor vehicles account, but it relates to the new van. So we're going to debit the van account or the motor vehicles account for £3,500. And we're going to credit disposals for £3,500. Now, the difference there is that we're essentially recording that trading proceeds as part of the value of the new asset. Yeah. What we would have done previously is we would have debited the bank. We received the money into the bank. Debit, bank, credit, disposals. Well, what we're saying here is we're not receiving the money into the bank. We're receiving the money against the value of the new asset. Yeah. So the debit entry needs to go to the value of that new asset, in this case, the new van. So £3,500 debited to van. Yeah. Credit disposals for £3,500. We can then balance the accounts like we normally would do. And you'll see we've got £12,000. This is the balance the disposals account. You'll see we've got £12,000 debit entry. And then we've got two entries on the credit side of disposals. One for the accumulated depreciation, £9,000. And one for the trading proceeds, which is £3,500. So we've got £12,500 on the credit side. So again, when we look at that, we've got a profit on disposal. The credits are higher than the debits. We've got a profit on disposal, £500. So then we can record or post that profit. Yeah, so we balance up the disposals account. So we're going to debit disposals £500 and credit profit on disposal on the statement of profit or loss for £500. That balances our disposals account to zero. There's one more thing we need to do though, because haven't we bought another asset? Yeah. So we need to record the full value of the new asset. Yeah. So the full value of the new asset was £18,000, wasn't it? Yeah. Now we've posted the trading proceeds. We've already posted those against the value of that new van. So we need to post the rest of it. Yeah. So remaining £14,500. Yeah. Needs posting into the van account. So we're going to post a debit for £14,500 into the van account. Yep. And then we're going to credit the bank because the money left our bank account. Yep. And then when you balance the van account now, you should see that, you know, you've got the £3,500 part exchange allowance plus the £14,500 that you paid, physically paid at the bank. The value of the new asset then is £18,000. So hopefully that all makes sense. I advise people just to re-watch the video a few times if you know, and pause it as you go through if you need to, you know, make some notes, or certainly reach out to me on LinkedIn, reach out to me on Facebook. I'm on Facebook. I'm on lots of the AAT support groups. I'm obviously on LinkedIn. You can reach out to me should you have any problems with any of that. So I just want to move on now to look at some of the common mistakes that students make when looking at non-current assets. So one of the key things that we see is students forgetting to transfer both cost and depreciation to disposals accounts. I've definitely seen it where people have transferred cost but not depreciation, or they've transferred all depreciation for all assets. Well, you just want the cost and depreciation related to that particular asset, transfer that to the disposals account. The other thing we see is recording the new asset at the amount paid after trading, not at full cost. Yeah. So we don't record, you know, I've seen people forgetting to record the fact that the new asset's cost is the full cost not just what you actually paid after trading. Yeah. The other thing we see is posting proceeds directly to income without a disposals account. Yeah. So saying, well, I've received £3,500 for that van, I'm going to post it to some form of income account, other revenue. Yeah. No, it should all go through the disposals account, balance the disposals account. Only the profit or loss on disposal should be posted to income. Yeah. Now, the disposals account should always reflect the asset's original cost, the accumulated depreciation, any proceeds that we received for that asset, yeah, or part exchange allowance, yeah, and then the profit or loss for that asset, which is then transferred to the statement of profit or loss. So in today's episode, then, we've covered quite a lot. It's a slightly longer episode than some of our other episodes have been, but I just think it's worth us recapping what we've looked at today. So we've looked at the difference between capital and revenue expenditure. It's an important differentiation there. Capital expenditure, the acquisition and improvement of non-current assets. Revenue expenditure, day-to-day running cost. We've looked at how we can acquire assets, either with cash or credit. We've looked at how we dispose assets through the use of a disposals account. We've looked at how we process part exchanges. And we've looked at how we calculate and post the profit or loss on disposal. Now, it's important to say that understanding disposals is not just important for AAT. It's part of every accountant's toolkit. It's something you're definitely going to be doing at some point in your accountancy life. Yeah, because people buy assets and sell assets on a daily basis. Yeah, well, we don't do it every day, but you generally get what I'm saying is that people are always buying assets, always selling assets. It's what makes the world go round. So you're going to need to know how to account for the acquisitions and disposals. So the challenge before Thursday's episode then. So the next episode will drop on Thursday. That will be episode 4. So the task before episode 4 then is a business part exchanges a machine costing £20,000 with £14,000 of accumulated depreciation. It receives a trading value of £5,500 towards a new machine that's worth £25,000. And the balance is paid by bank transfer. What I'd like you to do then is post all the entries to the disposals account, the profit or loss account, the new asset account, and to the bank. Yeah, so basically do all of the all the entries required to dispose of that asset, acquire the new one, account for the part exchange, and account for the fact that we've got balance to pay. So that is it then for episode 3 of Debit Credit Done. We've learned how to treat the full life cycle of an asset from acquisition to disposal. And we've even looked at part exchanges. Now, in episode 4, we're going to almost fill in that missing bit from today. So the missing bit from today is around depreciation. So we're going to shift our focus to look at depreciation. We're going to look at why we use depreciation. We're going to look at the different methods of applying depreciation. So straight line method, reducing balance method. We're going to look at how depreciation affects financial statements. Because depreciation connects everything directly between a statement of financial position and a statement of profit or loss. It ties the two things together. So until then, keep practicing, keep reflecting, and remember, debit credit done. Till next time, thank you.